Thank you all for joining me today. All right, we are going to be looking at introduction to option trading. So just to give everyone who's not knowledgeable about options, who doesn't currently trade them, or if you just need a refresher, this will all be good. Let's get into it. Let's talk about options. Again, this is Beginner Friday, so we are going to be, covering just some basic stuff. We're not going to get into any strategies that would be more for advanced traders, but we will, be just talking about options in general. Okay, money management rules. Obviously, do not trade with money you can't afford to lose. This is something I always emphasize to the people who I mentor. Always trade with an R that's small enough that it feels insignificant to you if you lose. And the reason for that is you don't want to be, you don't want to have that stress and that pressure on you of, well, I just lost money and now I can't, buy milk for my child today, right? So I always kind of use the analogy of like, if I lose the R that I'm trading with might be, something that I could say, well, okay, that's dinner out one night with the family, or, it's not going to Starbucks for a week for some type of a latte, right? So anyway, you get the point. Trade with an R that's small enough that it feels insignificant to you if you lose. This next one, never risk more than 2% on your account, any one trade. I mean, that is, again, kind of a rule of thumb that you'll hear, but I think the more important part of that is I actually don't use the 2% rule. I just picked my R based on a number that works for me. Keep it small, especially at first. If you're new to trading, choose an R and then divide it by 2. So that would be my suggestion to everyone out there. Just choose an R that is a number that you're comfortable with. And if you lose it, you're okay. So the question, are options risky or are they too complicated for new traders? And I know that for new traders, options can seem a little overwhelming. They can seem complicated, but you can simplify them and you can trade with them in a way that is very straightforward, very simple. The truth is options can be very safe to trade. Okay. And the reason they can be very safe to trade is that the risk is predefined. If you buy an option, whether it's a long call or a long put, up front what your risk is. It's predefined. And you're either willing to accept that risk or not. And when you trade options, whatever that premium is the cost for that option, you don't have to put all that at risk. You can use a stop loss. And there's a couple different ways that you can use a stop loss to minimize your risk. So yes, it can be very safe to trade options because the risk is predefined. They can be very simple to trade. So last week, we covered debit spreads, which was, it's more of an advanced strategy, but it also is very straightforward, kind of simple. But even simpler than that are the directional options. So I'm talking about buying calls or buying puts. And when you buy an option, you're considered long that option. So even if you buy a put, most people think of puts as of short. That just means that your sentiment what you believe is going to happen is that price is going to go down. So your sentiment is bearish, but it's still a long put. Long is just the term that means that you purchased it versus being short an option, which means that you're the seller of that option. So if you're long, you're a buyer. If you're short, you're a seller. And that goes for whether it's a call or a put. So, and again, a call would be used if you think price is going to go up, and a put would be used if you think the price of the underlying is going to go down. And again, the options are all tied to some type of an underlying asset, whether that's a stock or some other things that we'll get to in a couple of minutes. But anyways, they can be very simple to trade, directional long calls or long puts. The key is knowing how to trade them. And that's why we're here today. We're going to talk about how do you safely trade options? How do you choose which ones you're going to select? All those good things. Okay. So a long call option, what is it? Here's the definition. A long call option, it gives you the right, but not the obligation to buy a specific stock at a fixed price, meaning the strike price, and we're going to get into what the strike price is, anytime before a specific expiration date. the option seller is obligated to sell you the stock at a predetermined price if you choose to exercise the option before the option expiration, right? Going to give you a quick example. Okay, long call options, okay? So let's say if this is the option chain for Amazon right here, okay? And it gives you, and Amazon, I think last that I checked, it was trading at, where is it right now? It's like around 138. Okay. So around $138. So it gives you the right, but not the obligation to buy a specific stock at a fixed price. Okay. So when you look at this option chain, if I go out to September, actually I'll use October, which when you read this, it's the 21st of October, 2022, 63 days left before expiration. And this is a monthly option. So there are weekly options, there's monthly options. So obviously these and say weekly, those are the weeklies. Everything else here is a monthly. So if I go out to October and I look at this option chain and I go, okay, well, Amazon is currently trading at $138 right now. And I go, well, I think I want to buy it at, I think it's going to get to 147, right? So 147. And let's say Amazon just completely rips. And by the time this expires, price is 200. Okay. You can exercise your option before it expires and buy those shares at $147 and then turn around immediately and sell them for 200. Right. So that's the definition of the long call. And that's the explanation in terms of, and we're going to get into things like in the money, at the money, out of the money in a little bit. But that's just the just to give you the idea that if you were to buy this 147 call expiring in October, that gives you the right to, you can at any time before expiration, you can exercise that option to purchase those shares for $147. All right. Let's talk about the long call option, maximum loss and gain. So maximum loss, it's predefined. It's limited to the premium you pay for the long call option. So in that example I'm not going to go back to the other screen, but right now that 147 call is roughly about $4.50, let's just say. Okay. So $4.50, and you got to multiply that by 100. So that would be $450 if I wanted to buy that call. So the maximum loss is whatever I pay for that long call option. So $450 if I wanted to do that particular strike that we just looked at. That's my predefined loss. Maximum loss is whatever I pay for that long call. Okay. Again, long meaning I'm buying it. In theory, the maximum gain for a long call option is unlimited. So let's say between now and October, right? Price just every day is just jumping by 100 points, just keeps going. Well, in theory, my maximum gain is unlimited because it's however high the price of that underlying goes up between now and when the option expires. So again, the value of the long call option, it increases as the price of the underlying stock moves up in price. Okay. Now, long put options, right? So again, a call option, you are speculating that price is going to go up. It's a bullish thing. Long put options is you're speculating price is going to go down. So you're bearish. You have a bearish outlook. Okay. This gives you the right, but not the obligation to sell a specific stock at a fixed price. So now you're selling at a fixed price, which is the strike price, anytime before a specific expiration. And the seller is obligated to buy the stock from you at a predetermined price if you choose to exercise the option before the expiration date. So it's very similar to the long call, just the opposite. You're going in the other direction. We'll just look at that option chain again. Right now, again, Amazon is trading right around 138. Okay. So if you wanted to do an option, let's say the 100. So it's, again, it's a specified stock at a fixed price anytime before the expiration. So the seller would be obligated to buy the stock from you. So even let's say if you just sold the 135 and all of a sudden Amazon just tanks and it goes down to 90, you have the right to sell at 135. So your profit is the difference between the 90 and the 135. Okay. So similar to the long call, you're just going the opposite direction with it. Okay. So let's talk about the maximum put, the maximum loss and gain for a long put option. Okay. Maximum loss is predefined. It's whatever you paid, the premium that you paid for that put. Okay. So again, predefined. That's how you control your risk. Okay. The value of the long put option increases as the price of the underlying decreases. Okay. So that's a little bit different. The value of the long call put option increases as the price of the underlying decreases. Okay. Maximum profit is going to be capped, right? Because the stock can only go to zero. So whatever zero is, that is the maximum, that's the maximum gain, right? Whereas with a call, right, price can go to infinity. Not that it would, but it could in theory. But when you're going short on something, when you have a put, the price can just go, the underlying can go to zero. So your maximum gain is capped at zero. So option contracts. Okay. So unlike shares, right, you can buy 1 share, 2 share, 100 shares, 300 shares, however many shares. You can buy them in increments of 1. An option contract is 1 option contract equals 100 shares of the underlying. So if you bought an option contract for $1.25, you have to multiply that by 100. So your actual cost for that 1 contract would be $125. If I go back to the option chain here, again, of Amazon, so you just have to move the decimal 2 points to the right, okay, to know how much this is going to cost to purchase, right? So right here, $4.70 would be $470. So just multiply it by 100 or move the decimal point 2 places to the right. Okay. The underlying assets. Now, we're talking mainly today about doing options on stocks, but it's not just limited to stocks. You can trade options on indexes like SPX, SPY, Qs, right? So you can do options on indexes and futures. But for anybody just starting out, I would recommend just sticking to just doing the puts and calls on just the underlying stock itself. Okay. So now in the money, at the money, out of the money. Okay. So there are 3 different levels or price categories, if you will. So in the money is a call option with a strike price below the price of the underlying, or it's a put option with a strike price above the underlying. Okay. So in the money, right? This first, if you notice here on Thinkorswim, this area here is shaded, this area here is shaded. Anything in the shaded area is going to be in the money. Okay. So all of this is in the money. All of this is in the money. So again, call option where the strike price 135 is below the current price of the underlying. So again, Amazon's at 138. This option is at 135. So therefore it's in the money. Okay. On the put side, the put option with a strike price above the underlying. Again, price is at 138, 140 would be above that. So this put would be considered in the money. And then you can go deep in the money. The further you go into the money, the deep into the money or in the money. Okay. Then we have at the money. So at the money is where the strike price is the same as the price of the underlying. So we don't really, in this Amazon example that we've been going back and forth, Amazon's trading at 138. There is not a strike price that's 138. So therefore, the at the money price would be the 140 strike. So again, 135, if we're talking about calls, 135 would be in the money. 140, because there is no 138 call option strike price. 140 would be the at the money. Then you have out of the money. Okay. And out of the money is a call option with a strike price that is higher than the price of the underlying, or a put option where the strike price is lower than the price of the underlying. I'll go back real quick to the option chain here. Okay. So out of the money, right? Out of the money here. So this, let's call it this 149, right? Way down here. That is the price of the underlying. So the call option where the strike price is higher than the price of the underlying. So again, Amazon at 138, this is 149. So that would be out of the money. And then on the other side here, again, if price 138, something here like 95 or 94 would be out of the money. Okay, option value. So there's a couple ways that the option, the value of that option is determined. So there's intrinsic value, okay? And intrinsic value is the in the money portion of the options premium. So if the strike price of the option is $35, okay, and the underlying stock price is $55, then the intrinsic value is $20. So there's intrinsic value and extrinsic. And extrinsic value is the difference between an options price and its intrinsic value. So let's say if Amazon trading at 138 and then the intrinsic value is 20, it would be the difference between that, right? So not that you have to get too much into this, is just information for you, because when you're trading, you're really not going to be looking so much at these values. I mean, you can if you really want to get into the nuts and bolts of it, but I'm going to simplify this. I'm just throwing it up here just so you understand, how options are valued. And then the other thing that controls or impacts the price of the option or the premium that's charged is the implied volatility. When the implied volatility is high, the option premium increases. And then when implied volatility is low, the option premium decreases. So let's go back. Okay. So on the option chain, let me just collapse this real quick. Okay. When you look over here, you can just do a quick eyeball check right here. So Amazon, all these percentages here, that is the implied volatility. And if you look, they're all pretty close, right? There's nothing that really jumps out at you that is, a crazy high number. So you can quickly look at that and go, well, I think, all of these seem to be pretty much in line with each other, right? More or less. If you go to, you'll notice that the implied volatility greatly increases as you get close to earnings. I'm trying to think of who has earnings coming. Okay, so here, right? Zim, we use this as an example. Look at this 92% right here compared to with down here 55, right? So when you look at this, you go, okay, well, I know that that's high because I see a 55 here, I see a 62, I see a 64. So 92, and of course that's expiring today, but even like next week's, right? Next week's is at 86. That is high implied volatility. Now, you want to be careful when you're a buyer of options, because you want to buy options that have low implied volatility, not high. The other way that you can check this out is if I go into my charts here. Okay, so if you go to Amazon here and you right click in the chart and studies and you go to edit studies. Okay, if you scroll down here, you'll find implied volatility study. You add that. Okay, and then if you go up a little bit, there's historic volatility. Add that. Click apply or okay. And then down here, that plots for you. Here's the historic volatility, and then the implied volatility is above it. And this is saying that right now, the historic volatility is 0.18, but right now, the implied volatility on Amazon is 36. So it's basically double what the historical implied volatility. So question, okay, given what I just said, would now be the time to buy options on Amazon based on implied volatility? No. The key to buying options is to buy them when implied volatility is low. And right now, the implied volatility is double the historic. So that's right. This would not be the time to be looking to buy options on Amazon. So you go and you look for another setup, another trade that has, let me see. I'm curious. That's a 3-minute chart. Let me see if it changes if I go into, yeah. Okay. So it does change based on the daily. I'm glad I just noticed that it was on the daily, not the, because it does change. So I'll take that back. Now, this shows that the current implied volatility is 36, but the historic is 52. So then we have a different idea now. Yes, that the implied volatility is low compared to the historic on the daily chart. So we could, this would be a time if you wanted to go long on options. So I apologize for that. I didn't notice that was on the 3-minute chart. So we do want to be looking at this on the daily. So implied volatility is low right now. So this would be a good time if you're a buyer of options on Amazon. Option contract facts, okay? So over 80% of all option contracts expire worthless, okay? For this reason, sellers of options have a higher probability of profit. And that is true, okay? When you look at buying or selling options, your probability for profit is much greater if you're a seller of options. So for instance, if any of you are familiar with the naked put strategy, right? So one of the reasons that works so well, selling naked puts, is because the fact that over 80% of all options contracts expire worthless. And if anybody's interested, if we have time at the end, I'll get in a little bit to what naked puts are. But the reason I like selling naked puts is you collect the premium, you get paid to be the seller of something that you don't even have. Your only risk is that you might have to buy X number of shares of the underlying. So I'm netting it right now, and I can go into more detail if we have time at the end. But when you sell naked puts, let's say if I sold naked puts on AMD, right? And right now, price on AMD is 94. Just call it 94, right? 95. If I sold naked puts on AMD, it's a stock that I don't mind owning, and I wouldn't mind owning it at a discount. So I could sell naked puts on this at 80, collect the premium for doing that, and my only risk is that then I have to buy AMD at $80. And why would I not want to own AMD at such a discount, right? Again, we can get more into the details of the naked puts if we have time at the end. So again, over 8% of all contracts expire worthless. Most buyers overpay. So most buyers of options don't think about the things we've already talked about, the implied volatility, and they end up overpaying. So they don't go, they just see, well, I want to go long on, Amazon or Tesla, and I don't want to buy shares, so I'm going to buy calls. Well, they don't look at the implied volatility like we've just done. And oftentimes they'll just buy it when it's high, the implied volatility. They're overpaying, they're paying a premium. And at that point, the underlying really has to make a really strong move in order for those options to be profitable. So if you're going to be buying directional options, whether they're calls or they're puts, you want to make sure that you do check the implied volatility like we've just done. And then you don't want to be buying options when there's a spike in implied volatility. And I just touched on this, that overpriced options, when you overpay or you pay a premium on the premium, overpriced options must make a really strong move to be profitable. So overpriced options often end up losing money, even though the underlying goes in the direction that you expect. So let's say you bought a call on Tesla, you did it at a period of high implied volatility. Well, if it doesn't make a really strong move in your direction, let's say Tesla just kind of slowly inches up over the course, you can actually, even though it's moving in your direction, the value of your options can actually lose money because you overpaid because you bought when implied volatility was high. Option profitability, buying options. Okay. there's 5 potential outcomes. So 5, when you're the buyer of an option, there are 5 potential outcomes. Price can move strongly in your favor, in which case you're going to be profitable. Price can move slightly in your favor, you might be profitable. And now we're talking about the price of the underlying, right? So if you bought AMD like Rock did, if price moves strongly in his favor, it's going to be profitable. If it moves slightly, he might be profitable. If AMD just goes sideways and remains flat, it's going to be a losing trade. Okay. He will not be profitable due to theta. And we're going to talk about what theta is in a little bit. If it moves slightly against you, you're going to lose money. You will not be profitable. And if it moves strongly against you, you'll not be profitable. So if you look at these 5 potential outcomes, this is when you're buying options. So when you're a buyer of options, whether it's call or put, you have a 2 in 5 chance of making money, really, because you have to, but again, you have to select the right option. It's got to be right at the correct implied volatility. So, the probabilities are not in your favor when you're buying option, which makes it all that more important. The selection, right? The options that you select. Now, if you're a seller of options, it's a different ballgame. Again, because going back to what we talked about earlier, where 80% of options contracts expire worthless. Okay. If you're a seller of options, if price moves strongly in your favor, you're going to be profitable. Okay. So if let's say I sold a naked put on AMD at $80. Right now it's at 95. AMD goes to 100, right? That's moving in my direction. That's in my favor. I'm going to be profitable. If it moves slightly in my favor, I'm still going to be profitable. AMD can go sideways and do nothing, and I'm going to be profitable. AMD can actually slightly move against me, and I can still be profitable because I get paid. I collect the full premium for selling a contract. So unless that contract at expiration is in the money, I keep that premium. So the only time that I can lose when I'm a seller is if price moves strongly against me. So in that example that I was just given with AMD, if I sold an $80 AMD naked put and let's say it goes strongly against me and it expires at, instead of 80, let's say it expires at $79.99. I then am going to be, it's called being put the shares. However many contracts that I sold, I will have to buy. You have to multiply that by 100, and that's how many shares I will have to buy of AMD. So, but again, I will only do that on the underlying that I don't mind owning and I would like to own at a discount. But you can see here that when you're a seller of options, the probability is much more in your favor. You have a 4 out of 5 chance of winning versus 2 out of 5. And really that other one is really more like 1 out of 5, right? So the Greeks. So there are things called the Greeks, and there's a lot of them, but I'm just going to give you the ones that you need to know. And let me go back to let me change the screen share real quick. Go back to the option chain. Okay. If I let's pull up this October 1 on AMD. Okay. Right up here. Okay. These are the Greeks: theta, gamma, delta. Okay. Yeah, it is better to be a seller of options, right? So that's, I'll still do directional option trades. I do like, instead of just outright buying call options, I do like the debit spread strategy that I shared with everyone last week, where you're actually using the market's money to offset your cost. So that's a nice, I prefer that over buying just straight up long calls or puts. I prefer to use a debit spread. But anyway, these Greeks here, theta, gamma, delta. You also notice these, I have a couple of things here: open interest, probability of in the money, implied volatility right here, right? Again, you can look at here and go, see right away that this particular strike has extremely high implied volatility. And then when you get down here, it's much lower. And then the mark, okay? And the mark is right here. So in terms of the Greeks, here's what you need to know. I'm just going to keep things very simple in terms of what you should be thinking about. Delta, okay? So, and we'll go back to the option chain in a second to look at this. But when you're talking about delta is how much that option will increase or decrease per every dollar that the underlying moves, okay? So if you're an AMD and it goes up $1 or goes down $1, delta is how much that is going to move based on that $1 movement. And this changes every dollar for the underlying. So if the value, if you're in a call and let's say you have a delta of, let's say 30, right? And AMD starts going up, well, delta is going to change with that. It's going to work to your benefit. But if AMD starts going down, your delta is going to decrease. So that's, the delta is just something to be aware of again, how much that's going to, the value of your option is going to change based on a $1 move on the underlying. Theta is time decay, okay? Theta is not a friend to the buyer of an option, and it is the best friend for a seller of options. And what theta is again, it's time decay. So theta is how much the value of the option will decrease each day if the underlying price remains the same. So, and again, I'm going to give you some examples in a second. So let's say you get an AMD and AMD doesn't even move. It just keeps going sideways. So there's a certain amount of time decay based on if AMD just doesn't move at all. But that also changes with the price of the underlying. The thing that you really need to know if you're going to trade directionally with options is that theta accelerates in the last 30 days prior to expiration. And that's very important to know, because if you own options, if you bought options and you're holding options, whether they're calls or the puts, the last 30 days in that 30-day window, theta is going to accelerate and the value of those options will start going down, even if price is moving in your direction. So you need to be aware of that you want to, and we're going to talk about how you're going to plan that out, but you do want to try to be out of your calls prior to 30 days to expiration. Okay. I always use this terminology. Think of options as penny stocks. Now, I am in no way suggesting that people go out and trade penny stocks. They're a waste of time, waste of money. But if you think about options in terms of being penny stocks, what do I mean by that? Well, if you're buying shares, think about it. If you buy 100 shares of Amazon, it's going to cost you, based on Amazon's price today, $13,800, okay, for 100 shares. But you can buy an option contract on Amazon at the money, and it will only cost you $1,000, okay? And we're going to take a look at that. We're going to look at that example. But you can see here, right, you are controlling 100 shares of Amazon because it's one contract. So if you buy a single call on Amazon, you'll pay $1,000. You're still controlling the same amount of shares as if you bought 100 shares of Amazon, but instead of laying out 13,800, it's only going to cost you 1,000. Okay. Now the trade-off here is that the value of that option is not going to move dollar for dollar, right? So you have 100 shares, Amazon goes up, $1. Well, it's going to go up $100. It's not going to go dollar for dollar when you're talking about option contracts. And that's the trade-off. So if you buy a call, that's the trade-off though, for not having to put up 13,800. You're only putting up 1,000. So therefore the increase in the value of that option is not going to be a one-to-one. And I'm going to give you some examples. Let's look at this example that I came up with, right? Was if I bought an at the money or in the money in this case, since there's not a $138 strike on Amazon, I use this 135 as the example, right? So it would cost me, $1,000. I'm just netting it, right? $1,000. Okay. Now, what I need to look at here is that the delta on that is 60 cents. Okay. So that means for every dollar move that Amazon makes, it's going to go up 60 cents. Okay. Now, the more farther that this moves, let's say if it continues moving, it's going to increase. So you can see here that right at the money, right in the money, this one here is a 60 delta. But you can see the farther that you go in the money, that increases, right? So if you were to buy this 135 Amazon call, and let's say Amazon starts heading into, much higher, well, this call option is going to end up going farther and farther in the money, and delta will increase, right? So if you look, there isn't a delta that is equal to $1 in Amazon, right? The closest you get is 97. And that would have been if you bought the 92, and then it's not moving 1-to-1, but it's pretty close, 97 cents per every dollar it goes up. So yes, you are not getting that 1-to-1 benefit, right? So if Amazon goes up $1, your value of your option contract is not going to go up $1, but you're also not putting out 13,800, right? Hopefully that makes sense. So that's the trade-off. Okay, selecting the expiration date. So if you're buying options for a swing trade, okay, you want to use the chart and select the target price to determine how, and you need to figure out how many days you think it's going to take for price to hit that level. Okay. If I go to Amazon and we will look at it on the daily, let me go to further out. Okay. If I look at Amazon, right? And so right here on Amazon, this is, the daily chart, and it's over the course of 1 year. Okay. And I look at Amazon and I think, okay, Amazon has made this nice move. It's pulling back a little bit, and it's now I'm going to target, let's say Amazon is at 138 now. I'm going to target. So here's a trend line that I drew. And I think Amazon can get up into this trend line here, and then it might pull back, but I'm going to target, let's say, the 150 area. So if I'm looking for the 150, I'm going to go back to my option chain here. I'm going to look at this and I'm going to say, okay, well, how long do I think it's going to take for it to get to 150? Okay. And if I look here on the option chain, so if I'm looking for this for a swing trade, I do not want to get, the idea here is you want to figure out how much time you think it's going to take to get there. And then you want to add 30 days, because again, you want to be out of this contract before you get into that 30-day window when theta really starts to kick in. So if I'm looking at Amazon at 138, and let's go into, let's say I'm going to just target 150, right? So I need a $12 move. How long do I think that's going to take? Okay. Well, one way I can do is I can look at this October without even opening up the option chain. I can look at this one right here, which is 63 days, right? So if I take out 30 days, that means I have 33 days for price to get to 150. Then I can go over to here, okay? And what you see over here is this the implied volatility. This right here in the parentheses where it says plus or minus 17, just call it 17 and a half. That's how much the market maker is anticipating Amazon can move in the next 63 days. So this is one way that you can judge it. You can look at this and say, well, I think it's got to move. I need to move $12. They're saying, and I need to do it in 33 days. And they're saying 63 days, it can move 17 and a half, right? So you could look at that and think, Okay, well, maybe that's a possibility. Then you go back to the chart of Amazon and you try to figure out, well, it's a $12 move. You could simply get into here and check the low of this 132 up to 138 or 146. I'm sorry. So let's say that's $10, right? That's a $10 move. Well, it's called just doing a measured move. And you can just draw a trend line here from the high to the low. Take that measured move and throw it on here and see if it crosses, right? And it does. Or you can just look at it and say, okay, well, so not even a month, right? So it took less than a month for this to move 10 points, right? All you're trying to do is just gauge how long you think it's going to take to make that move. So then you go back to your trade, and at a minimum, you would want to do the October. So if you wanted to do the October, then you go down to the 150 here, and you look at this and say, okay, well, 150, and we're going to get into a couple other things that you want to look at, and I don't want to get ahead of ourselves, but this would be the one that you would select. Okay, the 150, and you're going to pay $3.50. Okay, or you could go out a little bit further, 91 days. Okay, and by November, if you look at November, it's saying that it would expect Amazon to make a move of $23. So definitely in terms of just crunching the numbers, the November gets you there, should get you there, no problem, right? So the October one, right there kind of on the border, because again, you're not going to hold it for 63 days. You're going to only hold it for 33 days. Here, you basically can hold it for 61 days, right? Before you want to get out. So if you're buying options for a day trade, okay, and you can day trade options. So if you're going to day trade options on a Monday or a Tuesday of a week, you can use the current week's expiry. The further you get into the week, and I'll give you an example in a second, but further that you get into the week, let's say Wednesday's still kind of iffy. Wednesday, you still might be able to use, it's called the front week, that Friday's expiration. But I typically on Wednesday, Thursday, and Friday, I'll then look to use the following week's weekly expiration, those contracts. So again, if I go back to the option chain, and let's say I want to trade, and today was Friday, right? And I wanted to trade options on Amazon today. Well, I'm not going to use today's expiry because you can see it's changed now, but the implied volatility was through the roof because today everything was expiring. You want to use the following week, next week's expiration, right? You have 7 days. So then next week on Monday or Tuesday, I would still use this weekly one. Wednesday would be questionable, but Thursday and Friday, definitely I would then go down. I would go out to the following week. So early in the week, it's okay to trade the options that are expiring that Friday. But as you get later into the week, you want to look at the following week's expiration. Okay. Selling options. Again, if you remember that when you're selling options, theta works in your favor. Theta is a seller's best friend. You want to sell options that have 40 or days less to expect expiration. Ideally, you want 30 days or less, because again, theta kicks in, accelerates in those last 30 days before the expiration. So 40 would be the maximum days that are out that I would look to sell, but ideally, I want to do it 30 days or less. Okay. Now we're going to get more into delta, open interest, implied volatility, and the spread. Okay. So for delta, I'll go through these and then we'll look at the option chain. So for delta, these are just my rules. I won't buy an option with a delta of less than 20. So ideally, I want the most, and this will be an out of the money option. I'll show you that in a second. Would be a 20 or a 25, and then I typically will cap that at 70, at a 70 delta. And this again all depends on the move that I'm expecting the underlying to make. So if I'm going farther out with my expiration and I expect a pretty large move, I can go farther out of the money. It's going to cost me less money for the option versus going with a 70 delta. And again, we're going to go back to the option chain in a second and look. But again, my rules, not less than 20 delta, and then I don't go any higher than 70. Open interest. I'm looking for a minimum open interest of 100, right? And the interest is the key word here. Basically, it's just giving you an idea of how many people, how many contracts have been purchased, at that price. And that you can determine, well, are there a lot of people out there who think that that is a good strike or only a few? So minimum open interest of 100. And again, we'll go back to the option chain in a second. Implied volatility and expected move. We already talked about that. Okay. So you can look at the current IV versus the historical, and then also look at that market maker's expected move that I just showed you a minute ago on the option chain. And then the bid-ask spread. And this is no different than when you are trading a stock with a wide spread, right? And when I'm trading stocks, I mean, aside from Delta, ideally I'd like to be trading something that has like a 5-cent spread, right? Because the spreadier the stock, the greater if you lose a full R, it's not going to be a full R. It's going to be more than a full R. So with like Tesla, when you're wrong trading Tesla and you let it get to a full R, you can easily lose more than an R just because of the spread. Okay. So there's a bid-ask spread on the options as well. And I like to keep it at 30 cents or less. But ultimately, I'm going to try to get filled at the mark. So let's take a look at all this on the option chain so you can see what I am talking about. Okay. If I go back to this October one here, okay, and I was looking at the 150, right? I was thinking, okay, Amazon could probably move to 150 by October, right? So first thing I'm going to look at is the delta, okay? Delta, 31 cents. That fits my rules. I said no less than 20. So that means it's within my rules. It's a 31-cent delta. And then I look at open interest, this column here, and look at the open interest compared to the strike prices around it, right? And I did just randomly select this, but that is a very telltale sign. That's a lot of open interest on this 150. So the higher the open interest, the more likely that is going to get to that level, right? So if you come down here and you look, I mean, there's, the only other ones that have that high of open interest are right at the money. But when you go out farther here to this farther out, so this, again, these are going to be less expensive. This is going to cost me $3.50, $3.55 versus $7.50. So you're looking at the delta, the open interest. We talked about the implied volatility, how much it's expected to move in that time frame, and then the bid ask. So the bid ask here, if you're looking at Amazon, it's a 10 cent spread, and the mark is 350. So if you definitely want to get filled on this, let's say this is during the regular trading hours right now. If you were to right click on the buy and just buy single, okay. Well, I guess this did. It looks like the order entry. Here we go. So it would be 3 contracts. I would be buying it, the 150 strike, and the price would be 355. That's if I want to go ahead and just buy it at the ask. I never buy anything at the ask. So if you put in the bid, you're not going to get filled, but you can go with the mark. And that's why I have the mark here. So I would change that to 350, hit confirm and send, and then see if I could get filled at 350. So the mark is just that midpoint between the bid and ask. And oftentimes you can get filled there. Now, I will say that I know that there's Thinkorswim is really good with the fills when you go with the mark. Interactive brokers, not so much. So sometimes I've noticed with interactive brokers, like you actually have to hit the ask to get filled. Whereas with Thinkorswim, you'll most likely get filled if you go with the mark. All right, so that's actually all the slides. So let's go to look at some real examples in terms of applying all this and putting this into practice. Okay, does anybody have a particular ticker you want to look at? So any tickers, throw me out a ticker if somebody wants to look at a CMG. Got it. Let's take a look. Okay. CMG. Wow, pricey. Chipotle. All right, so Chipotle. Let's say if you want to, Tim, you want to try like target the high here, get a sense for like how long it might take to get back to the highs. Okay, so let's just call it 1950, and it's currently trading at where to close today. 16. We'll call it 1675, just to keep the number simple. Okay, so we want to try to make a move up to 950. We're going to target 950 for a call option, right? Because we are looking for this to go bullish back up to here, to the previous highs. So if we go back to, so let's just look at this move here, okay? From 1715 minus, call it 1435. So that's a $280 move. And that happened between the 27th and now, okay? So we're talking, less than a month, right? So less than a month, it made a $280 move in less than a month. But now we're trying to get up here to up into here, right? The 1950. So coincidentally, that is 275. So we're looking for a move from here to here, which is equivalent to this move here. And it did it in less than a month. So again, we're just trying to estimate approximately how long it might take to get up here. And just based on the chart, it looks like they could do that in a month, right? 30 days. So if we go back to the option chain, we want to look over here. We want to check, make sure that we are not in a high implied volatility area. And we're not. Everything looks pretty much the same, right? Somewhere in the mid to high 30s, right? Low 40s. We can go back to the chart. We can just double check. We can throw on the studies. Implied volatility, historic volatility. And look at this, and we can say, okay, well, the implied volatility is 30 cents. The historic is 51. So pretty clear that we are in a period of low volatility with CMG right now. So that's good. So we're already checking off one of the boxes we need to check off, which is we do not want to buy an option in a period of high volatility, right? So we're confirmed that we have low volatility. Go back to the option chain, okay? So CMG, we're looking for a move of about 280, right? So right here, we have a December one that's 278. That's pretty close. Now, CMG just did that in about a month's time, right? So if we just figure, let's say a month, 30 days, now we have to add another 30 days, right? Because we want to be out of this within 30. So we're at 60 days. So a minimum, we are at this October one here, right? 63 days. But when you look over at the expected move for October, it's 188. Doesn't really get us there. So I would be looking at I'd probably be looking at this December one here, right? Because this is very close to what we're trying to target, that 280-ish, okay? So if we go to the December one, we want to scroll down. We're targeting 1950, right? So that's going to be down here. That's going to be out of the money, okay? So we have a 1940 and a 1960. And when I go over here, the open interest, right? We're only at 5. So if I'm following my rules, I can't take this trade. I can't set this up because there's not enough open interest. I could go here to the 1900. Okay. So 1900 has an open interest of 159. That's doable. Okay. And then the delta, let's check the delta, 29. That works for me. If I go back here to 2000, I can look at the 2000. It meets my minimum requirement for delta. It has 292 for open interest. So this one does meet my minimum requirement, bare minimum requirement. 20 delta, open interest of 292. So I could do that one. It's a bigger move than I'm anticipating, but CMG can move a lot. So I was targeting 1950. This would need to target 2000 by that date. Again, I was looking for a $280 move. That move would be beyond this. So I could look at, and if you look at the price here, I mean, it's pricey. So we're talking, move this move the decimal 2 places to the right. We're talking almost $3,700 for a single contract. If I wanted to go, if I thought, well, that really isn't putting the probabilities in my favor, let me go up here to this 1900 one. Now I'm looking at $6,000 for a single contract. So it's a very, very expensive ticker to be looking at in terms of buying options. And again, there's not a ton of open interest. Let's take a look at, we can take a look at Apple. Okay. Apple's had a really nice move here. Question is it going to pull back? And at this point, I think everything is going to pull back. So I would be, looking at this now, but thinking to myself, well, I need this to pull back. Then I'm going to look to find the options that are going to work. Because one thing, again, when you are buying options, when you're buying a call, you don't want to, just like when you're buying shares, you don't want to be buying at the top of a move, right? You want to wait for it to pull back. So you could start looking at this now, start setting it up. And then when the time comes, find the particular options that meet your criteria and that work for you. But if I were looking for a pullback, if let's say this pulls back into here, okay, I could then target the previous high here. Let's call it one, I could target like 180, something like that. But I would have to wait for it to come back into this area here, pull back into here, then target 180. Then I go back to the trade tab. Again, you're going to want to check this implied volatility. You're going to want to see what the expected move is. So if it was 160, let's say it got down here at 160 and it showed me some type of a reversal signal like, okay, pullback has happened. It's going to go back up. I'm going to go from 160 and I'm going to target 180. That's a $20 move. So if I go in the trade thing here and I look, this is based on today, but $20 move somewhere in here would be November. So I would go into the November and I would look at we said we were going to target 180. So we're looking at it's just out of the money. All right. So this would be at the money. This would be in the money. This would be just out of the money. We're looking at a let's call it $630 per contract. You have a delta of 40 and there's really nice open interest. So actually all of these strikes right here have really nice open interest. So does this one, which is okay. So look, nice open interest, but the delta on this is only 13 cents. So that would not work for me. Again, minimum delta of 20. So it would have to be one of these strikes here. But again, I would not be looking to do that now. I would have to wait for Apple to pull back, show me some type of reversal signal. Because again, this is where we would be buying this call up here at the high. So you want to apply the same strategies for buying options as you do for buying shares, meaning that you don't want to buy at the top, right? You want to buy as low as possible. So wait for this pullback, then you go in and you go through all these steps and you find the strike prices with the expiration that meets your criteria. So I hope you found this helpful. Please head on over to reallifetrading.com. We have a great community. You can sign up. We have a live trading room that takes place every single day. You can exchange ideas in Slack. I can't say enough good things about reallifetrading.com. Thank you for your time. Appreciate it, and hope to see you in the future.